Simply link your investment returns to the things that inflate. In this episode, I'm going to address a question that I've been asked thousands of times. Doug, what do you do to combat inflation? I'll share with you why I've always been able to earn a rate of return greater than the inflation rate at any given time. So, my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 48 years. And I've been helping many thousands of Americans prepare for long-term goals such as retirement, to be able to not outlive their money when they get to retirement. But there's a lot of other long-term goals, maybe college funding for your kids, your grandkids, or working capital for a business or whatever. And people will ask me, well, Doug, what's your favorite investment or financial vehicle to be able to set aside serious cash and not jeopardize it, not lose it when the economy is topsy-turvy and going through all kinds of gyrations? And how do you earn a rate of return that will be equal to or greater than the inflation rate? How do I combat inflation? So get ready. In this episode, I'm going to share with you, it's really simple, how to link your returns to the things that inflate. I don't like inflation any more than you probably do, but it doesn't hurt me. It actually helps me. But it's amazing how many financial advisors do not understand what I'm about to teach you. So I mentioned, I've been doing this a long time. I started in 1974, and in the late 70s, President Carter, Jimmy Carter, he took over, and he's like sometimes politicians who have never run a candy store before. And he was printing money and what have you. Inflation got to double digits and even as high as 14%, because he was doing things quite similar to what President Biden did even the first year of his office here. And so I'm recording this episode at the end of the first calendar year since he took office. And we've seen inflation already, I think a 30-year high ever since the Carter years, because he's been printing money like crazy, thinking that's the best way to pay for all of this spending that's been going on. Back during the Carter years, when inflation hit, let's say 10%, I was earning 15.5% on my money, which was more than 5% the cost of inflation. So yeah, I don't like 10% inflation, but I was earning 5% more than that. So I've always been blessed to earn at least 5.5% rate of return greater than the inflation rate at the time to outpace inflation. Now, I may not be able to handle runaway inflation, but normal inflation, even if it gets double digits, which it is right now as of the recording of this video, and we're talking about the true rate of inflation is more like 14 or 15%. Towards the end of 2021. And sure enough, in 2021, I and many of my students and clients of the advisors I point my students to have locked in gains of 25%, 32%, even 61.33%. And a handful of them have locked in gains of 153% this year because they understand what's going on and how to link their returns to the things that inflate to be able to outpace inflation. And yet, I can't believe how many advisors go, huh? How do you do that? Okay, so let me explain what I mean by link your returns to the things that inflate. So if you subscribe to this channel, which I would recommend you do, there's a lot of episodes that talk about my favorite financial vehicle where I put probably 40 to 60% of my serious cash, and I would recommend you do that also, is in a maximum funded indexed universal life insurance contract structured with the least amount of death benefit the IRS will let you get away with, and you put in the most money the IRS allows as fast as they allow, and it turns into this tax-free cash cow, where historically, if I have earned an average return of, let's say, 11%, I'm netting 10% internal rate of return, cash on cash. That 1% difference is not tax, because these are tax-free. It's the cost of the insurance that the IRS says has to be there in order for it to be tax-free. But I'm okay with that. It's not really a cost because I get millions of dollars of insurance coming along for the ride. Nothing's free, but I'm not paying for it. That insurance is being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax. My heavens, I'd have to earn 15% in a tax-deferred IRA or 401k in the market to net 10 after paying tax on those when I retire. Does that make sense? I only have to earn 11 to net 10 in a max-funded IUL policy. So how does this combat inflation? With indexed universal life, the money you have in there, you can choose to link to an index any year you want. So if I have $1 million by the time I retire in an IUL policy, let's say, I can settle in a year if I feel bearish about America. I think we're headed for a recession. And they'll just pay me the general account portfolio rate of 4% or 5%. At 4%, that'd be 40 grand tax-free, which as of the recording of this episode is 4 times as much as banks are paying, and it's actually safer. But anytime I feel bullish about America, I can tell the insurance company, link my returns to an index or indices that they offer. It could be the S&P 500, the Dow Jones, the Russell 2000, the Barclays U.S. Dynamic Balance Index. There's a whole bunch. Let's simplify it. Let's say you choose the S&P. Now, it doesn't mean the insurance company is putting my million at risk in the S&P 500 in the market. No, it stays safe in the insurance company, earning 4. What I'm giving up is that for sure 4% or 40,000 that year, and I'm allowing the insurance company to use that $40,000, that interest on my million, to buy upside options in the index that I chose, the S&P. So that that 40,000 of options, if the market goes up, it allows the insurance company to pay me 8. If the S&P went up 8, 12, maybe up to a cap. Some years there is no cap. Like this year, 2021, many of our clients were chose to go to a no cap in March of 2020 when the market dropped 30%. And sure enough, in March of 2021, there was no cap and many clients got credited 61.33%. We had a client with $850,000 in March of 2020. That was worth $1,380,000 in March of 2021, tax-free. And if the next year the market crashed, they would not lose one dime of that $1,580,000 if the market went down. Because if the market crashes and you're linked to an index, the options just expire worthless. But the money you started out with is still there. Your money is not at risk in the market. So when you combat inflation, what you're doing is you're using indexing to link to an index. And I found that when you do that, see, the linking to the market allows you to participate on what the economy is doing. And the economy is based upon goods and services that if inflation's happening, those are going up in price, in value. So you're coming along for the ride. You may not like inflation any more than I do, but it doesn't hurt you. Because if inflation goes to 5, I've earned 10. If it goes to 10, I earn 15. If it goes to 15, I earn 20. If it goes to 20, I earn 25 and 30, which has happened this year. That's how you outpace inflation, by linking your returns to the things in the economy that are inflating. It's actually quite simple, but I teach this to financial professionals sometimes, or CPAs and attorneys, and they go, huh? How come I've never heard of this before? Yeah, you can't be aware of something you're not aware of. You don't know what you don't know. So let me invite you, before I connect the dots here, I don't want you to miss out. If this is intriguing you, be sure and share this episode, this video, with somebody who would benefit by clicking share, post a comment, click like, but most importantly, subscribe to this 3-Dimensional Wealth channel. It's free. And then click that little bell so that you'll be notified every time I post a new educational video, which I do almost on a daily basis. But stay with me to the end. I want to gift you a copy of my most recent 300-page best-selling book. It retails for $20. I want to give you a copy, and I'll show you how to claim your free copy at the end. Here we go. How do I combat inflation? As I said, I don't really like inflation more than anybody does, but it doesn't hurt me because I'm linking my returns to the things that inflate by using max-funded indexed universal life. If inflation goes to 5, I've usually earned 9, 10, 11% when inflation was 5. When inflation was 3, then I was earning 8. When inflation goes to 10, I usually earn 15. When it goes to 15, I earn 20. As of the recording of this episode this year, many people with inflation, the true rate of inflation at 14 or 15%. Now, if you're going, wait a minute, that's not what I've heard. I've heard inflation is more like 5 or 6%. They only gave Social Security recipients a 5-point-something% increase. If you're not aware, during the Carter years, Congress decided we can't afford to pay Social Security retirees the actual cost of living increase of 14%. So they changed the way that they calculate and report inflation with the CPI, Consumer Price Index. Basically, they changed from comparing a basket of goods and services to the same basket of goods and services the next year, like an apples to apples comparison. It's apples to oranges now. So they can actually compare the price of an 8-ounce filet mignon steak last year to 8 ounces of hamburger this year if they choose. And they do that. So when they report the consumer price index went up, 5 or 6%, you can almost triple that for the real rate of inflation. You can see it at the gas pump, the price of meat, the price of used cars, the price of houses. Hello. And so if inflation is 20%, you need a strategy where you can earn more like 25% or higher during those types of years. That's done through a max-funded IUL, which I call a laser fund. Why? Because the IUL has to be structured correctly and funded properly. So if you want to learn more about this, I would recommend you claim your free copy of this book. So it's called the Laser Fund. You click on the link below or go to laserfund.com. You contribute a nominal amount towards the shipping and handling, have some skin in the game. I will cover the rest of that cost, and I will pay for the book and fire out a copy to you. It's 300 pages, actually 2 books in one. This one is 200 pages, 14 chapters with all the charts and graphs. If you're more of a right brain learner, you flip it over and read this one. 100 pages, 12 chapters, 62 client stories. You can read both if you want to use your whole brain. But folks, claim your free copy. But there's options when you're in there to listen and learn, watch and learn. Check out the Retire by Design virtual events we teach on a monthly basis. Those are normally $600 tuition. We can waive that and allow you to attend that at no charge whatsoever. So check it out, study, and begin to take ownership of your brighter future, and never let the negative impact of inflation affect your hard-earned dollars again.